हेलो दोस्तों, बिगनर्स पॉइंट में आपका स्वागत है। और अभी हम कर रहे हैं इकोनॉमी। ठीक है, तो इससे पहले कंप्लीट कर चुके हैं। ट्वेल्थ की मैक्रो इकोनॉमिक्स चल रही है, ये मैक्रो इकोनॉमिक्स चल रही है और 2 चैप्टर कंप्लीट कर चुके हैं, तीसरा चल रहा है। ठीक है, पॉलिसी टूल्स टू कंट्रोल मनी सप्लाई। रिजर्व बैंक इज द ओनली इंस्टीट्यूशन विच कैन इशू करेंसी when commercial banks need more funds in order to be able to create more credit. They may go to market for such funds or go to the central bank. Central bank provides them funds through various instruments. This role of RBI, that of being ready to lend to banks at all times, is another important function of the central bank, and due to this central bank is said to be the lender of last resort. The RBI controls the money supply in the economy in various ways. The tools used by the central bank to control money supply can be quantitative or qualitative. Quantitative tools control the extent of money supply by changing the CRR or bank rate or open market operations. Qualitative tools include persuasion by the central bank in order to make commercial banks discourage or encourage lending, which is done through moral suasion, margin requirement, etc. It should be evident by now that if the central bank changes the reserve bank reserve ratio, this would lead to change in lending by the banks, which in turn would impact the deposits and hence the money supply. In the previously discussed example, what would the money multiplier be if the RBI increases the reserve ratio to 25%? Notice that in the previous case, rupees 100 in reserve could support deposits of rupees 400, but the banking system would now be able to loan rupees 300 only. It would have to call back some loans to meet the increased reserve requirements, hence money supply would fall. Another important tool by which the RBI also influences money supply is open market operations. Open market operations. Open market operations refer to buying on and selling of bonds issued by the government in the open market. Open market operations क्या होते हैं? Open market operations में जो bonds होते हैं, जैसे कि गोल्ड बॉन्ड्स, इनको खरीदा या बेचा जाता है गवर्नमेंट के द्वारा ओपन मार्केट में. दिस परचेज एंड सेल is entrusted to the central bank on behalf of the government. When RBI buys a government bond in the open market, it pays for it by giving a check. This this check increases the total amount of reserve in the economy and thus increase the money supply. Selling of a bond by RBI to private individuals or institutions leads to reduction in quantity of reserve and hence the money supply. There are two types of open market operations: outright and repo. कौन कौन से हो गए? आउटराइट और repo. Outright open market operations are permanent in nature when the central bank buys these securities, thus injecting money into the system. It is without any promise to sell them later. Similarly, when the central bank sells these securities, thus withdrawing money from the system, it is without any promise to buy them later. As a result, the injection absorption of the money is of permanent nature. However, there is another type of operation in which, when the central bank buys the security, this agreement of purchase also has a specification about date and price resale of this security. This type of agreement is called repurchase agreement or repo. इसको क्या कहते हैं हम? repurchase यानी कि दोबारा परचेज करना. repurchase agreement. The interest rate at which the money is lent in this way is called the repo rate. और इसको क्या बोलेंगे हम? repo rate. Similarly, instead of outright sale of securities, the central bank may sell the securities through an agreement which has a specification about the date and price at which it will be repurchased. This type of agreement is called a reserve repurchase agreement or reserve repo. The rate at which the money is withdrawn in this manner is called the reserve repo rate. The Reserve Bank of India conducts repo and reserve repo operations at various maturities, overnight, 7-day, 14-day, etc. This type of operations have now become the main tool of monetary policy of the Reserve Bank of India. The RBI can influence money supply by changing the rate at which it gives loans to the commercial banks. This rate is called the bank rate in India. By increasing the bank rate, loans taken by commercial banks become more expensive. This reduces the reserve held by the commercial bank and hence decrease money supply. A fall in the bank rate can increase the money supply. Box 3.1, Demand and Supply for Money, a detailed discussion. Money is the most liquid of all assets in the sense that it is universally acceptable and hence can be exchanged for other commodities very easily. On the other hand, it has an opportunity cost. If instead of holding on to a certain cash balance, you put the money in a fixed deposit in some bank, you can earn interest on that money. While deciding on how much money to hold a certain point of time, one has to consider the trade-off between the advantage of liquidity and the disadvantage of foregone interest. Demand for money balance is thus often referred to as liquidity preference. People desire to hold money imbalance broadly from two motives. The transaction motive, first one is the principal motive for holding money is to carry out transactions. If you receive your income weekly and pay your bills on the first day of every week, you need to hold any cash balance throughout the rest of the week. You may as well ask your employer to deduct your expense directly from your weekly salary and deposit the balance in your bank account. But our expenditure patterns do not normally match our receipts. People earn incomes at discrete points in time and spend it continuously throughout the interval. Suppose you earn rupees 100 on the first day of every month and run down this balance evenly over the rest of the month. Thus, your cash balance at the beginning and end of the month are rupees 100 and 0 respectively. Your average cash holding can then be calculated as rupees 100 plus 0 divided by 2 equals to 50, with which you are making transaction worth rupees 100 per month. Hence, your average transaction demand for money is equal to half your monthly income, or in other words, that the value of your monthly transactions. Consider next a two-person economy consisting of two entities, a firm owned by one person and a worker. The firm pays the worker the salary of rupees 100 at the beginning of every month. The worker in turn spends this income over the month on the output produced by the firm, the only good available in this economy. Thus, at the beginning of each month, the worker has a money balance of rupees 100 and the firm a balance of rupees 0. On the last day of the month, the picture is reserved. The firm has gathered a balance of rupees 100 through its sales to the worker. The average money holding of the firm as well as the worker is equal to rupees 50 each. Thus, the total transaction demand for money in this economy is equal to rupees 100. The total volume of monthly transactions in this economy is rupees 200. The firm has sold its output worth 100 to the worker and the latter has sold her service worth 100 to the firm. The transaction demand for money of the economy is again a fraction of the total volume of transactions in the economy over the unit period of time. In general, therefore, the transaction demand for money in an economy (MDT) can be written in the following from MDT equals to K into T, where T is total value of nominal transaction in the economy over unit period and K is positive fraction. The two-person economy described above can be looked at from another angle. You may perhaps find it surprising that the economy uses money balance worth only rupees 100 for making transactions worth over 200 per month. The answer to this riddle in simple: each rupee is changing hands twice a month. On the first day, it is being transferred from the employer pocket to that of the worker and sometime during the month it is passing from the worker's hand to the employer's. The number of times a unit of money changes hands during the unit period is called the velocity of circulation of money. In the above example, it is to inverse of half the ratio of money balance and the value of transactions. Thus, in general, we may rewrite equation 3.1 in the following form: 1 upon k into m dt equals to t, or v dm dt equals to t, where v equals to 1 upon k is the velocity of circulation. Note that the term on the right hand side of the above equation, t is a follow variable where has money demand. MDT is a stock concept. It refers to the stock of money people are willing to hold at a particular point of time. The velocity of money "v", however, has a time dimension. It refers to the number of times every unit of stock changes hands during a unit period of time, say a month or a year. Thus, the left-hand side "v" into mdt measures the total value of monetary transactions that has been made with this stock in the unit period of time. This is a flow variable and is therefore equal to the right hand side. We are ultimately interested in learning the relationship between the aggregate transaction demand for money of an economy and the nominal GDP in a given year. The total value of annual transactions in a economy includes transactions in all intermediate goods and services and is clearly much greater than the nominal GDP. However, normally there exists a stable positive relationship between value of a transactions and the nominal GDP. An increase in nominal GDP implies an increase in the total value of transactions and hence a greater transaction demand for money from equation 3.1. Thus, in general, equation 3.1 can be modified in the following way: mdt equals to kpy, where y is the real GDP and p is general price level or the GDP defaulter. The above equation tells us that transaction demand for money is positively related to the real income of an economy and also its average price level. The speculative motive: an individual may hold her wealth in the form of landed property, bullion, bonds, money, etc. For simplicity, let us club all forms of assets other than money together into a single category called bonds. Typically, bonds are papers bearing the promise of a future stream of monetary returns over a certain period of time. These papers are issued by governments or firms for borrowing money from the public and they are tradable in the market. Consider the following two-period bond. A firm wishes to raise a loan of rupees 100 from the public. It issues a bond that assures rupees 10 at the end of the first year and rupees 10 plus the principal of rupees 100 at the end of the second year. Such a bond is said to have a face value of rupees 100, a maturity period of 2 years and coupon rate of 10%. Assume that the rate of interest prevailing in your savings bank account is equal to 5%. Naturally, you would like to compare the earning from this bond with the interest earning of your savings bank account. The exact equation that you would ask is as follows: how much money, if kept in my savings bank account, will generate 10 rupees at the end of 1 year? Let this amount be x. X plus 1 5 divided by 100 equals to 10. In other words, x is equal to 10 divided by 1 plus 5 divided by 100. This amount rupees x is called the present value of rupees 10 discounted at the market rate of interest. Similarly, let y be the amount of money which, if the kept in the saving bank account, will generate rupees 110 at the end of 2 years. Okay, thus the present value of the stream of returns from the bond should be equal to PV plus x, PV equals to x plus y equals to 10 divided by 1 plus 5 divided by 100 plus 100 plus 10 plus 100 divided by 1 plus 5 divided by 100 का square. Calculation reveals that rupees 109.29 approx. It means that if you put 109.29 in your saving bank account, it will fetch the same return as the bond. But the seller of the bond is offering the same at a face value of only rupees 10. Clearly, the bond is more attractive than the savings bank account, and people will rush to get hold of the bond. Competitive bidding will raise the price of the bond above its face value till price of the bond is equal to its PV. If price rises above the PV, the bond becomes less attractive compared to the saving bank account and people would like to get rid of it. The bond will in excess supply and there will be downward pressure on the bond price which will bring it back to the PV. It is clear that under competitive assets market condition, the price of a bond must always be equal to its present value in equilibrium. Now consider an increase in the market rate of interest from 5% to 6%. The present value and hence the price of the same bond will become कितना हो जाएगा ये 10 डिवाइड बाय अप्रॉक्स कितना हो जाएगा 1.107.33 अप्रॉक्स. It follows that the price of a bond is inversely related to the market rate of interest. इससे market rate of interest से inverse inversely related है. ठीक है. Different people have different expectations regarding the future movements in the market rate of interest based on their private information regarding the economy. If you think that the market rate of interest should eventually settle down to 8% per annum, then you may consider the current rate of 5% too low to be sustainable over time. You accept interest rate to rise and consequently bond prices to fall. If you are a bondholder, a decrease in bond price means a loss to you, similar to a loss you would suffer if the value of a property held by you suddenly depreciates in the market. Such a loss occurring from a falling bond price is called a capital loss to the bondholder. Under such circumstances, you will try to sell your bond and hold money instead. Thus, speculations regarding future movements in interest rate and bond prices give rise to the speculative demand for money. When the interest rate is very high, everyone accepts it to fall in future and hence anticipates capital gains from bond holding. Hence, people convert their money into bonds. Thus, speculative demand for money is low. When interest rate comes down, more and more people accept it to rise in the future and anticipate capital loss. Thus, they convert their bond into money, giving rise to a high speculative demand for money. Hence, speculative demand for money is inversely related to the rate of interest. Assuming a simple form, the speculative demand for money can be written as MDS equals to R max minus R बटे R minus R minimum. ठीक है, where R is the market rate of interest and R max and R minimum are the upper and lower limits of R, both positive constants. It is evident from the above equation that as R decrease from R max to R minimum, the value of MDS increase from 0 to infinite. As mentioned earlier, interest rate can be thrown off as an opportunity cost or price of holding money balance. If supply of money in the economy increases and people purchase bonds with this extra money, demand for bonds will go up. Bond prices will rise and rate of interest will decline. अगर bond prices rise होंगे तो rate of interest decline होगा. Rate of interest क्या होगा, increase होगा, तो फिर bond के price क्या होंगे, decrease होंगे. In other words, with an increased supply of money in the economy, the price you have to pay for holding money balance, whereas the rate of interest should come down. However, if the market rate of interest is already low enough so that everybody accepts it to rise in future, causing capital losses, nobody will wish to hold bonds. Everyone in the economy will hold their wealth in money balance, and if additional money is injected within the economy, it will be used up to satiate people's craving for money balance without increasing the demand for bonds and without further lowering the rate of interest below floor R minimum. Such a situation is called liquidity trap. The speculative money demand functions is infinitely elastic here. In figure 3.1, the speculative demand for money is plotted on the horizontal axis and the rate of interest on the vertical axis. When R equals to R max, speculative demand for money is zero. The rate of interest is so high that everyone accepts it to fall in future and hence is sure about a future capital gain. Thus, everyone has converted the speculative money balance into bonds. When R equals to R minimum, the economy is in the liquidity trap. Everyone is sure of a future rise in interest rate and a fall in bond prices. Everyone puts whatever wealth they acquire in the form of money, and the speculative demand for money is infinite. Total demand for money is in an economy is therefore composed of transaction demand and speculative demand. The former is directly proportional to real GDP and price level, whereas the latter is inversely related to the market rate of interest. The aggregate money demand in an economy can be summarized by the following equation: MD equals to MDT plus MDS. MD equals to KPY plus R max R और divided by R minimum. The supply of money various measures, इसको पढ़ेंगे अब कल.